I'm going to start by, mentioning some of the data you brought up in the book itself, right? For instance, you said capital flows hit about 9 trillion in 2007. At that time, it was about 16% of the global economy. They've come down to about 1.2 trillion, 1980 levels. That diminishment in capital flows is quite incredible. Do you expect that they will ever go back anywhere close to the levels in the big financial boom, or are we doomed to live at these levels for a long time now?
Well, I don't know whether we're doomed, but I think that this is part of this entire section that I've covered in the book about deglobalization. And this is one key aspect of it, that you have capital flows which have collapsed. You have trade flows which have collapsed. In fact, for the first time now, outside of a recession, trade flows are actually, trade volumes are actually contracting this year.
Yes.
And these are huge shifts taking place, and then we have a rise in protectionism. That if the WTO and other organizations tabulate protectionist measures, and if you look at it, the rise in protectionist measures which has taken place in the last few years has been quite unprecedented. And India has been at the forefront of this. The country that has taken the maximum protectionist measures this decade, in fact, has been India. So I'd say that this is the combination going on, that you got capital flows which have collapsed because banks today are much more reluctant to lend across borders. The main reason capital flows exploded in the 1990s and last decade was that banks were lending a lot beyond their borders. Now banks in Europe and America, for obvious reasons, have become much more risk averse and are just not lending as much. And we pay so much attention to portfolio flows and FDI flows, but cross-border bank flows was really the big chunk of the explosion in capital flows which took place, and a reason why that's collapsed of late. So this is the era of deglobalization. It's not all gloom and doom. There are some ways in which the world is much more interconnected today, thanks to social media, the internet, and also some random figures such as tourism flows and all are at record highs. But in general, the way that we thought of globalization for a generation has really fallen into much harder times now.
Okay, I used that one data point. I'm going to use another one to get started on the conversation about the global economy. You said in the book, as a whole, the world has a bigger debt burden now than it did in 2008. That was one of the critical reasons for why we saw the big global financial crisis. You're now saying that in resolving all the situations that led to the crisis and all the monetary policy measures that we've seen, we've in fact seen that debt balloon since the 2008 levels. Is this not a bad omen?
Yeah, it is, but the key thing here is that how it keeps shifting, which is the fact that the big debt buildup last decade was led by the developed world, the European countries, and of course the United States and the housing bubble.
Right.
Now it is being led by the emerging world, particularly China. And just see as to what's happened in China. There's one key statistic that tells you, which is that today it's taking $6 of debt to create $1 of growth in China. At the peak of the US housing bubble in 2007, 2008, it was taking $3 of debt to create $1 of GDP growth in the United States. So that's the shift, that the risks have moved on, and today it is about China. China is where the debt levels are exploding on the upside, and it just is that the entire debt there is internally held. So there's no one out there to keep coming and calling for the debt. But the fact is that the situation has changed, but yes, it is a bit worrisome for me that the debt levels continue to go up, but China now is at the forefront of the debt build-up.
Okay, I'm going to come back to China in just a bit because you've written about it extensively in the book. But the third data point I wanted to bring up to you is not in your book. This is actually from Fitch Ratings. I think the Financial Times had an article talking about this the other day. $11.7 trillion of sovereign debt now carries negative nominal interest rates, right? It's a shocking number. It was apparently up by just 1.3 trillion in the last month itself. I think that data goes on to say about 2.6 trillion is in long-term bonds, and that only about 2 trillion bonds carry an interest rate of maybe 2% and more, right? So what does this mean for where we are in the global economy? We were trying to fix a problem in 2007, 2008. And I'm not sure whether we've fixed it or we've added to the problem or pushed the can down the road.
Yeah, this is a very unusual experiment because I've looked at inflation data going back the last 400-500 years, and we've had periods of deflation in the global economy, but we've never had negative interest rates before.
Yeah.
So this is very unique from that standpoint. But I think that the entire thing here is that this is also partly reflective of just how weak economic activity is everywhere. There's not a single region in the world today where economic growth is anywhere close to where it was in before the 2007 crisis. So therefore the whole book I divide into two segments, the so-called BC and AC, which is before crisis and after crisis.
Sure.
So this is reflective of how weak the global economy is, and the fact that central banks are also sort of running out of ideas and trying these new experiments now which aren't paying off that well. So I think this is more reflective of the weakness in the global economy than anything else out here, and the fact that there's such a rush for safety and you want to sort of be in whatever safe assets you can.
But there are consequences of all of this, right? Lower capital flows, higher debt burdens, negative interest rate debt. Are things going to get better before they get worse? Are they going to get worse before they get better? Or is it, as you say in your book, we're in for an era of very slow growth, or slow growth rather, not very slow growth. And that means that the kind of growth that we experienced when we were in our 20s and 30s in, about 10 years ago, 15 years ago, that probably will never ever come back.
Yeah, but I'm in that camp, which is that the global economy grew at about 3.5% or so for a lot of that period that you're talking about, and now we seem to be in this 2.5% range. That's a huge come down. In fact, someone did a back of the envelope calculation and said that the global economy was still growing at its old trend rate. It would be about $6 to $7 trillion larger today than where it is today. So that's the huge loss. But there's one very important point which I think is really underestimated, that we all want to look for structural reasons as to why this has happened, and we point to government policy, too much debt, and also factors such as too much regulation, etc. And like all that stuff is quite legitimate. But there's one really underappreciated factor as to why the global economy is much slower today, which is the world's population growth rate is much slower today. There are two drivers of economic growth. It's the world's population growth rate, or the labor force growth rate, and productivity. So a lot of focus on productivity, not enough on the fact that the global economy's population now is growing at a much slower rate than it used to. In fact, there are more than 30 countries in the world today with a negative increase in their working age population, led by China. So that's a huge swing which is taking place. And that's the main reason I think why the global economy today appears to be much weaker than it used to be, because the growth rates, you just can't get the same growth rates when so many countries in the world are seeing a shrinkage in their working age population.
I know you refer to it as the 2% pace test, I think, in your book. And I did have a question on whether, in order to have the growth that we are all talking about, or a return to the growth that we all experienced, whether that kind of increase in population is sustainable, just from the point of view of the air we breathe, the water we use. But I'll get to that in just a bit. Era of slower growth. The commodity markets seem to have factored that in, though you might say that they move in cycles, so they were bound to fall. But have the equity markets globally actually recognized what you're talking about? Have they got it right? Because the beginning of this year did seem like, yes, we were adjusting to the fact that that kind of growth will never ever come back. But there's been a great recovery since then. And so I'm not sure whether markets are reading it right, or are they so hopped up on liquidity that they can't read anything right anymore?
No, I mean, I agree with your latter point, which is the fact that asset prices across the world today are very high given where the global economy is. And a lot of the excess liquidity has gone into financial engineering, whether it's share buybacks and other things, rather than in sort of lifting economic activity. So there is definitely like an element of that. And the single most important decision which sort of rescued the markets this year, including China, was when the Fed in late Feb basically backed off
from the rate hike.
Exactly, from any rate hike, and turned much more dovish. So the role that liquidity has been playing in this is extremely important. Having said that, global equity markets for the last 2 years have really been stuck in a range. They haven't done much. So they go up and down, but they've broadly been stuck in a range.
But even at this point, they're expensive, they're overvalued?
Yeah, I mean, in terms of compared to their long-term earnings and stuff, they're mostly on the expensive side. Now, some emerging markets have got really beaten down and appear relatively cheap.
Sure.
But in general, asset prices today are relatively high, and liquidity is and very cheap money is the main reason why asset prices are so high. And that also is an issue that I've touched upon in the book, that's also leading to greater income inequality, because the people who own these assets which have gone up so much, stocks, bonds, even property, tend to be the rich people.
Yeah, it's the 1%.
Exactly. So they've benefited much more from these easy money policies than the rest of the public.
So you've just painted I know you didn't say it's not all doom and gloom,
right,
but you've painted a fairly dismal picture of what the global economy is going to look like in the years to come, and you've said markets are very expensive, or markets are overvalued at this point in time. So you are in a sense saying that we should be prepared for a correction in asset prices in the years to come. At some point, we're going to have to pay for all the sins that led to 2007-8, and then someone's going to have to pay for all the monetary policy easing that's happened in the last 10 years.
Or it could just be like a low return world, because money is easy. I don't see money getting sort of expensive anytime soon.
What do you call what is a low return in your book?
We've done these calculations. We don't think that there's any asset class out there which on an annualized basis is going to yield double-digit returns in the next 5 years or so. And you have places like US and stuff where I think we'll be lucky to get 2 to 3% type of returns every year for the next 5 years. So this is the consequence of the fact that asset prices have gone up so much. Having said that, there'll always be places in the world where you think you can do relatively better. So, and my entire concept, therefore, like in the book, is to come up with those countries where growth can be relatively high, because our work really shows that if you get that argument correct, that you end up identifying those countries where growth is relatively high, you will make outsized returns. So I think that's really the focus of the effort here.